Stocks muted this morning as investors brace for a big week ahead, including January jobs numbers and the latest rate decision from the Fed. Let's bring in Lakshman Achuthan, who is the Economic Cycle Research Institute co-founder, to discuss what you should be keeping an eye on. Great to have you here, back with us in studio here. So, of the top things investors should be watching over the course of this week, what is the key economic data point that is perhaps going to tip the scale one way or the other?
Right. For macro data, it has to be the PMIs. So these are surveys of managers. What are you up to? What are you feeling?
That's not the sexiest data point to call out, by the way. Let's just put that out there.
Purchasing managers. And then the jobs report. That's the big one at the end of the week to get the tone, the flavor of kind of where are we in the jobs report, where there's been headline jobs growth for a long time, right? An amazing amount of time. It has been slowing since 22, and it's a very clear downtrend in the headline growth. And underneath, there's some things that are looking a little weak. So that's a close one to watch.
What's looking more specifically a little bit weak in terms of the underlying data? Because we focus so much on those headline numbers there. What are some of the trends that you've noticed? And then how do you think the Fed is going to view what seems to be the most likely case, at least consensus right now, that maybe jobs are going to cool just a bit, but it's still overall going to remain pretty resilient?
Yeah. So let me unpack that. I'll give you the good and the bad. Which do you want first?
Give us the bad, and then we'll take the good.
And then we'll end with the good.
Yeah.
Okay. So on the bad, weekly hours. Yeah. So we're hired. A lot of people are hired, but their hours are going down, and they've declined in a way that you typically see around a recession. So this is a situation of employers feeling the demand softer, but not wanting to let people go. So they adjust the hours. Then we look at things like the kinds of jobs. There's a lot more part-time jobs than full-time jobs, and that's been a pretty clear shift. Again, you see managers keeping people employed, but keeping a lot of variability in how they are employed. And then a leading indicator of employment, one that makes a lot of sense, is temporary employment. Is it strong or is it weak? And that's down 10%. The level has fallen 10%. Again, that's pretty much recessionary. So that's the bad. I'll give you the good. Education and health, these two big sectors of our economy, and government to a degree, really steady as you go. Strong jobs growth. In 2023, I think we got 4% jobs growth in education and health. So really, really solid anchor underneath jobs growth. And then, of course, the amount of people who are out there, there's still some tightness in the labor market, a lot of backwash from immigration going down, legal immigration, and people moving around after COVID.
You know, it's particularly interesting when you're out at brunch with friends on a Saturday and the tech layoffs or any of the waves of layoffs that we've seen come forward, they make it to the conversation. And we're talking about economics at that point.
Yeah.
But we're also talking about whether or not that shows up in this print and acknowledging it's a mid-month to mid-month, perhaps in the next print that we get, do we start to see these layoffs show up in this?
Yeah, print? This is all the busyness under the water, under the surface of the water. I'm glad you brought up tech and then bigger companies. These companies have been letting go. Yeah. They've been making the adjustment. It's the smaller kind of mom and pop employers who had a very, very difficult time in 21 and 22 hiring people. The big companies were able to hire people, no problem, really fast. And the smaller firms and companies weren't able to, so they're very reluctant to let people go. And if you have something like a GDP print, which again is a headline number, not really what's going on underneath, come in stronger, like it did just last week, the mom and pop companies are going to be saying, hey, let me try to hang on. I'll reduce your hours, maybe you'll go part-time, that kind of stuff as a way to keep things going. I think for the Fed, they actually want jobs growth down, maybe even, dare I say, negative, because they're trying to really nail it with this inflation that was a big mistake earlier.
Lakshman, let's talk a little bit more about where we are in the inflation fight right now, getting back that final mile to that 2% level, what the Fed is targeting. We've been talking a lot about the disruption that's playing out right now in the Red Sea, a surge in cost there as a result of that, a shipping cost. What's the impact? Is there an impact, a real impact there on inflation? And what do you think that could do? And potentially, if it is, delaying the timeline of getting back to that 2% level?
Sure. So We're on a nice glide path down. We could get there, right? So let's just say that because there's inflation. But the key thing is inflation is cyclical. It goes down, but then it doesn't stay there. That's the weird part of the forecast. The expectation is it'll go down and just stick it and hang out there. What inflation does is it cycles up and down. Now you bring in supply chain issues. I think it's a very real concern of what we see going on in Red Sea. But then also we're seeing other indicators of inflation around the world starting to perk up. Remember, we've had this huge downturn globally. And at some point that runs its course and starts bottoming out. It looks like on the price side that maybe what's in store for us in 2024, supply chain issues are just adding on top of that. And the US can't disconnect from that global inflation cycle. We're going to be part of it too. So I think it starts to limit the amount of leeway that the Fed has in 2024. And that is at odds with expectations, right? Expectations are, hey, we're kind of mission accomplished here.
Yeah, and we see a lot of that optimism priced into the market as well. Lakshman, always great to have you. Thanks so much for coming on set with us here today.
Thank you so much.